In 1929, when the entire United States was intoxicated by the victory of the stock market, Joseph Kennedy quietly withdrew all his capital 6 months before the disaster struck and made millions of dollars by short selling. By 2008, when the housing market was hailed as an impregnable fortress, Michael Burry swam against the current alone, betting against subprime loans and raking in $700 million in profit. And now, as we stand on the threshold of 2025, a similar scenario is silently unfolding with steps exactly like the ghosts of the past. Or it remains those four stages, still investment positions arranged by the most powerful hands. I want you to see what they are doing right now, the things being hidden behind the glamorous curtain of market indices. There is an immutable pattern in financial history that repeats whenever market valuation reaches an extreme threshold. It is not random at all, nor is it due to luck. It is a four-stage sequence executed with mechanical precision by the same group of elite investors. While ordinary people blindly hold stocks until they lose everything, a small group has silently positioned themselves to reap huge profits from the collapse. They do not cause the crisis, but they see it from afar and prepare to catch the full flow of money from the inevitable panic. This happened in 1929, recurred in 2008, and is present right now, in 2025. Look at Warren Buffett. He is holding $325 billion in cash, the largest capital position in market history. Jeff Bezos has sold over $13 billion of Amazon stock. Mark Zuckerberg offloaded billions of dollars of Meta stock. The wave of insider selling is at a level unseen since 2007, just before the last great financial crisis. This is not a conspiracy theory. This is a recorded strategy. The positions are public, and once you understand how it operates, you will know exactly where we stand in this cycle. Let us dive deep into the details of these four stages to see how smart money is preparing for the moment of destiny. Stage 1 is the exit phase, usually taking place 12 to 18 months before the actual crash occurs. This is the time when seasoned investors begin to liquidate positions while the market is still on a strong growth trajectory. They do this not because they know the exact date and time the market will crash, but because they realize that valuations have reached unsustainable levels, and the risks have become much greater than the rewards. Looking back at history in 1929, Joseph Kennedy was one of the most successful speculators of the Roaring Twenties. He made millions of dollars running pools, coordinating buying to push prices up for insiders to sell out. But by the summer of 1929, despite holding large positions, he began to sell. There is a famous anecdote that Kennedy decided to exit after receiving a stock tip from a shoeshine boy. He reasoned that if even the shoeshine boy was speculating, there was no one left to buy. But that is just a side story. The reality was much more calculated. Kennedy clearly understood leverage and forced liquidation. In 1929, margin debt reached unprecedented records. Investors borrowed up to 90% of the value to buy more stocks. Kennedy knew that just a 10% drop would wipe out leveraged investors, trigger margin calls, and create a wave of panic selling. So he liquidated assets throughout the summer and early autumn of 1929. He was not alone. Bernard Baruch, another legend who had lived through the panic of 1907, also recognized the signs and switched to cash. By September 1929, both were completely out of the market. The Dow Jones Index peaked on September 3rd and 7 weeks later. On October 24th, Black Thursday struck, and they had exited right at the top. This story repeated in 2008 with different characters. Michael Burry, who ran Scion Capital, began studying subprime mortgages in 2005. He pulled loan-level data, examined the actual characteristics of borrowers, and what he found was terrifying. Adjustable-rate loans were granted to people who could not afford to pay when rates adjusted, loans requiring no proof of income, loans with attractive initial rates that would balloon after 2 years, all garbage. Yet they were rated A and traded as the safest investments. Burry concluded the system would collapse, but at that time there was no tool to short mortgage bonds. He had to work with Goldman Sachs and other banks to create a new instrument called credit default swaps, essentially insurance that would pay out if bonds defaulted. From 2005 to 2006, Burry bought billions of dollars in notional value of these contracts. He had to pay monthly premiums and lost money while the housing market kept rising. His investors were furious, thinking he had lost his mind and demanding to withdraw money. But Burry clearly understood stage 1. which is exiting the herd trade and positioning for the collapse before anyone else sees it. John Paulson also reached a similar conclusion in 2006 after studying home prices versus income. The bubble was obvious to anyone who actually looked at the data. Both Burry and Paulson were in stage 1 from 2005 to 2007, exiting long positions and building positions that would only profit if the system collapsed. So who is in stage 1 in 2025? Look at Warren Buffett. In his 2024 shareholder letter, when asked why he held so much cash, Buffett replied that he could not find anything at an attractive price. Translated: everything is currently overvalued. This is exactly stage 1 exiting when prices are high. But it is not just Buffett. Jeff Bezos sold over $13 billion of Amazon stock throughout 2024 and 2025. This is not small selling for diversification. This is a systematic liquidation of core positions. Mark Zuckerberg sold billions of dollars of Meta stock even as the stock hit new highs. Jamie Dimon, CEO of JP Morgan Chase, sold stock for the first time in his tenure. Insider selling across America has reached levels unseen since 2007. These executives hold information that investors usually do not have. They see real profits, real orders, and real problems before they appear in quarterly reports. And they are selling. This is the ultimate signal. The Buffett indicator, dividing total market capitalization by GDP, is at 185%, while his danger warning level is 120%. The signal could not be clearer. They do not sell everything at once because it would crash the market, but sell systematically over 12 to 18 months. While retail investors are buying in and believing artificial intelligence is the next revolution, the people running those companies are selling to them. Stage 1 is complete. Smart money has retreated. Next is stage 2, buying insurance for volatility, taking place 6 to 12 months before the crash. This is when sophisticated investors not only exit long positions, but also purchase protection that will pay out if the market falls. In modern markets, this means buying put options, VIX call options, or credit default swaps. The key is that stage 2 happens before the crash becomes obvious, when volatility is low and insurance prices are cheap. In 1929, volatility insurance was equivalent to short-selling stocks. After Kennedy and Baruch exited long positions, they began building short positions. Short selling means borrowing shares, selling them at the current price, and hoping to buy them back cheaper later. Kennedy established short positions on many stocks throughout the summer of 1929. He had to pay borrowing costs while stocks still rose, but he understood that when the crash came, these positions would explode in value, and reality proved it. When the market fell 89% over 3 years, Kennedy's short positions yielded estimated profits of $15 to $50 million, equivalent to hundreds of millions of dollars today. In 2008, the CDS contracts of Burry and Paulson were the tools of stage 2. From 2005 to 2007, they had to pay monthly premiums, about 2 to 4% per year on the insured amount. If you buy $100 million of insurance, you lose $2 to $4 million per year, receiving nothing if there is no default. Burry had to lock the fund to prevent investors from withdrawing capital because they could not bear watching the fees being lost. But by 2007, when subprime debt began to break and major financial institutions reported losses in early 2008, these contracts exploded in value. Bear Stearns collapsed, Lehman Brothers went bankrupt, and the contracts Burry bought for a few $1 million in fees paid back hundreds of millions of dollars. Paulson's fund took in $15 billion upon settlement. Bill Ackman also executed a perfect stage 2 move in March 2020. When COVID hit, Ackman bought CDS on corporate bonds for $27 million. In just a few weeks, as the market crashed 35%, these contracts paid back $2.6 billion, a 96-fold return in less than a month. So what is happening in 2025? Volatility insurance is being bought massively in many forms. The put-call ratio, measuring the volume of put options versus call options, has remained high throughout 2024 and 2025, showing institutions are hedging aggressively. VIX call options, which profit when volatility spikes, are seeing unusual buying activity with large volume, expiring in mid to late 2025. These are bets of tens of millions of dollars in premiums from institutions. They are paying fees right now to wait for a huge payout later. Especially insurance costs for commercial mortgage-backed securities, CMBS, have increased 300 to 500% since 2021. Sophisticated investors believe commercial real estate will collapse. Bill Ackman publicly discussed buying hedges in 2024 because he saw risks in commercial real estate and regional banks. He has not disclosed the exact position, but his public statement suggests he has finished positioning. This is exactly Stage 2 buying insurance, while it is cheap and waiting for the inevitable. Stage 3 is short selling specific sectors, from 3 to 6 months before the crash. This is the most aggressive phase, requiring absolute precision. You do not just short the general market, but must identify exactly which sector will collapse first. In 2008, Burry and Paulson did not just bet against housing in general, they found the specific worst bonds. Burry analyzed data and shorted loans in places with the wildest speculation like Florida or California. Paulson even shorted specific financial companies like Lehman Brothers and Bear Stearns in 2007, when Wall Street still rated these stocks as strong buy. He saw their balance sheets full of garbage and knew they were technically insolvent. When Lehman collapsed to zero, Paulson made billions of dollars. His fund's total profit from 2007 to 2009 reached $28 billion, mostly coming from the precision of this third stage. In the context of 2025, two sectors flashing red signals are commercial real estate and regional banks. Commercial real estate is falling into a death spiral that few understand clearly. Office buildings across America are 40 to 50% vacant due to the permanent remote work trend. These buildings were financed with 3% interest loans, now facing refinancing at 7 to 9%. A building struggling to pay interest at 3% will go bankrupt immediately at 8% out. Building values have dropped 40 to 60%, causing owners to choose default, handing the keys back to the bank like Brookfield did with two towers in Los Angeles. Over $2 trillion in commercial debt maturing in the 2025-2026 period will not be able to be refinanced. And who holds these debts? It is the regional banks. Unlike big banks like JP Morgan, regional banks have huge exposure to commercial real estate, accounting for 30 to 40% of loan portfolios. When these loans default, bank capital will be eroded, leading to bankruptcy. We saw a draft of this scenario with the collapse of Silicon Valley Bank and First Republic in 2023. Hedge funds are building huge short positions targeting commercial mortgage-backed securities and the stocks of the highest-risk regional banks. They are paying interest to maintain positions and waiting for the dominoes to fall. Finally, Stage 4. Buying when fear reaches its peak. This is the final destination where the previous three stages bear sweet fruit and smart money deploys capital to acquire assets at cheap prices. This stage happens at the bottom of the abyss, when everyone else is selling off in desperation. In 1929, after the market fell 89%, lasting nearly 3 years, Kennedy used cash to buy real estate and businesses at Great Depression prices, building a generational fortune for his family. In 2008, the market bottomed in March 2009, down 57% from the peak. At that time, Warren Buffett executed legendary deals. He invested $5 billion in Goldman Sachs and $5 billion in Bank of America, right in the eye of the storm, receiving preferred stock with 10% dividends plus warrants to buy cheap stock. These investments alone brought tens of billions of dollars in profit. Bill Ackman in 2020 was similar. After winning big with $2.6 billion from insurance orders, he went on TV warning of the collapse, but simultaneously silently used that money to buy quality stocks like Starbucks, Hilton when prices were crushed. Just 3 months later, the market recovered and he won big on both ends. How will Stage 4 of 2025 and 2026 play out? When the crash happens, possibly due to widespread commercial real estate defaults, the market could fall 50 to 60%. Unemployment will skyrocket, banks will collapse in mass, and the media will report on economic doomsday. It is in that chaos that Warren Buffett will unleash the $325 billion in cash sitting in wait. He will buy stocks, buy companies whole, and offer harsh bailout terms to businesses thirsting for capital. Private equity funds like Blackstone, KKR are sitting on mountains of undeployed cash worth hundreds of billions of dollars, waiting to acquire commercial buildings at 30 to 50 cents on the dollar. They will buy bad debt, buy foreclosed real estate, and hold for the recovery. This four-stage model is not magic. It is based on human psychology and market mechanics. Bubbles always burst, leverage is always unwound, and panic always creates opportunity. We are in Stage 3, waiting for the detonation moment. The question is not whether it will happen, but what you will do. If you cannot execute professional short sales, prepare for stage 4. Keep a larger cash position than usual, perhaps 20 to 40% of your portfolio. Buy a little insurance via put options if you understand it. And most importantly, have a list of quality companies ready that you want to own. When the market drops 50%, when fear is all-encompassing, ignore emotions and buy in. That is how wealth has been transferred throughout history, and that opportunity is coming very close. Smart money knows this. But do you?